Are you prepared for the biggest crash in history? The renowned author and financial guru Robert Kiyosaki has come forward with an urgent warning, and that should not be taken lightly. He believes we are on the verge of experiencing a crash unlike anything we've ever seen before, bigger and more devastating than even the catastrophic events of 2008. In this eye-opening video, Kiyosaki reveals the truth behind this impending disaster and provides invaluable insights on how to protect yourself and your assets during such hard times. So let's jump right in. In his latest alert, financial expert Robert Kiyosaki employs a powerful analogy to warn about the potential impending economic crash. He likens the current economic situation to a football stadium slowly filling up with water, drop by drop. Each drop represents a seemingly insignificant economic problem or challenge that may go unnoticed by the majority until it reaches a critical point. Kiyosaki introduces the concept of exponential functions, where the number of drops doubles in size every minute. This exponential growth then showcases how problems can escalate rapidly and become visible only when it's too late to prevent them. He points out that around the 15-minute mark, people in the stands might start noticing the field filling up with water. People in the stands will also notice that it's getting dangerous, but it's at 45 minutes, with just 5 minutes to go, that the entire field is covered by 3 feet of water. By this time, it becomes nearly impossible to avert the impending crisis, and the focus shifts to managing the impact. The football stadium analogy effectively illustrates the perils of exponential functions and their relevance to the current economic situation. Exponential functions describe a pattern of growth in which a quantity increases at an ever-accelerating rate over time. In the analogy, the exponential growth of water drops signifies how economic problems can compound rapidly, leading to a massive impact when they finally become visible. This concept highlights the importance of recognizing and addressing economic challenges proactively, as waiting until the problem becomes apparent can lead to dire consequences. In this warning, Robert Kiyosaki issues a prediction stating, "This is going to be the biggest crash in the world history. As investors, we must pay heed to the warning signs flashing all around us." Kiyosaki highlights the concept of the everything bubble, a perilous situation where multiple sectors such as stocks, bonds, credit markets, and more are vastly overinflated and detached from their intrinsic value. Robert Kiyosaki brings a unique historical perspective to this last alert about the world's biggest crash. With age and experience on his side, Kiyosaki emphasizes that having lived through previous economic cycles provides valuable insight into the patterns and pitfalls of financial markets. Drawing from his past experiences, he warns viewers to be wary of the current everything bubble, a situation he believes is larger and more dangerous than the 2008 financial crisis. In his alert, Kiyosaki calls out financial figures like Cathie Wood from ARK Invest and their claims, stating that this time it's different regarding the current market situation. With a sense of skepticism, he reminds us that throughout history, these words have often preceded major financial disasters. While some may argue that technological advancements and new economic paradigms justify such claims, Kiyosaki's historical perspective reminds us to be cautious and to not fall into the trap of the complacency during times of seemingly unprecedented market exuberance. Kiyosaki firmly believes that the excessive debt and continuous monetary manipulation practiced by governments and central banks are leading the world towards an inevitable default on financial obligations. He presents 2 potential scenarios: a deflationary austerity approach or an inflationary one through excessive money printing. The former may result in a collapse of the debt-ridden system, while the latter could lead to a severe devaluation of currencies. The recent 11-year bull run, which started in 2011, holds immense significance in the context of Kiyosaki's warnings. The extended period of market growth has instilled a sense of overconfidence, particularly among younger individuals who not only witnessed a major crash before. Kiyosaki's concern lies in disparity between this exuberance and the underlying vulnerabilities that may be lurking within the financial system. Kiyosaki's own experience during the 2008 crash serves as a pivotal reference point, shaping his current perspective on market conditions. Having navigated the turbulent waters of that crisis, he gained insights into the fragility of financial structures and the dire consequences of unchecked speculation. In his analysis, Kiyosaki calls out the trend of younger individuals who, despite their limited exposure to economic downturns, are readily providing financial advice. He questions the validity of such advice given their lack of experience in navigating a major crash. Enjoying this video? Give it a thumbs up and share it with your loved ones. Don't forget to subscribe and hit that notification bell to stay updated with our latest content. Now let's jump right back in. Robert Kiyosaki's criticism of central banks and the government policies has been prominent in his recent statements. In a tweet early in 2023, Kiyosaki strongly condemned the central bank's strategy of raising interest rates, predicting that it would lead to a catastrophic crash across various sectors. He warned that stocks, bonds, real estate, and even the US dollar would suffer, potentially causing a $1 quadrillion crash in the derivatives market. Kiyosaki's worries extend to the specter of inflation, which he believes is systemic rather than temporary. He challenges the assertion made by some central banks that inflation will subside in due time. Kiyosaki argues that the ongoing banking crisis, as exemplified by the struggles of institutions like Silicon Valley Bank and Signature Bank, could reignite inflationary pressures. Kiyosaki's criticism highlights the limitations of the Federal Reserve's power when it comes to controlling essential commodities like food and energy. While the central bank may have tools to influence interest rates and monetary policy, Kiyosaki believes that these measures do not directly impact the prices of essential goods. Apart from his criticism of the Federal Reserve, Kiyosaki also takes aim at President Joe Biden's stance on bank bailouts. He disagrees with Biden's assertion that bailing out troubled, or should I say extremely troubled banks like Silicon Valley Bank won't cost taxpayers anything. Kiyosaki's skepticism about the claim arises from the ongoing debate surrounding the cost of taking over the banks and the potential impact on the taxpayers through the Federal Deposit Insurance Corporation's Deposit Insurance Fund. Kiyosaki's investment approach challenges conventional wisdom, as he advocates for using debt strategically to accumulate wealth. This unique strategy involves leveraging borrowed money to invest in appreciating assets. For instance, during the 2008 crisis, Kiyosaki borrowed $300 million to buy prime real estate across the Southwest. This move allowed him to capitalize on the market opportunities when others were hesitant, ultimately leading to substantial gains. The calculated move allowed him to capitalize on the low market prices during the crisis. Kiyosaki is a firm believer in focusing on hard assets such as real estate and commodities. As the foundation of a strong investment portfolio, his preference for real estate is evident in his extensive portfolio of 13,000 apartment houses. These properties provide tangible value and have the potential for long-term appreciation. Unlike short-term speculation or flipping properties, Kiyosaki focuses on building a portfolio of income-generating assets that provide consistent returns over time. In his real estate investments, Kiyosaki adeptly employs various financial strategies to his advantage. One of the key aspects of his approach is maximizing tax benefits, appreciation, depreciation, and amortization. Through appreciation, the value of his properties increases over time, boosting his overall net worth. Depreciation allows Kiyosaki to reduce taxable income on these properties, effectively lowering his tax burden. Moreover, by utilizing amortization, he steadily pays down the mortgage on his properties, and then he builds equity. Robert Kiyosaki challenges conventional investment wisdom and encourages his audience to question traditional advice promoted by schools and financial planners. He argues that the typical approach of go to school, get a job, invest in the long-term portfolio of stocks, bonds, and mutual funds and ETFs is flawed and limited in its potential to build true wealth. Kiyosaki believes that blindly following this path can leave individuals vulnerable. Kiyosaki expresses skepticism about the popular 401k and IRA investment models. While these retirement accounts are widely promoted as safe and effective ways to save for the future, Kiyosaki believes they have inherent flaws. In contrast to the traditional idea of diversification limited to paper assets, Kiyosaki advocates for a broader and more comprehensive approach. He suggests diversifying one's investment portfolio by including hard assets such as real estate, precious metals, and commodities. These tangible assets can provide a hedge against inflation and economic uncertainty, offering protection during times of market turmoil. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.